in terms of where we are right now, this is what European futures look like. We are going to get a negative open, but it doesn't look anything like what we saw in Asia, which got hit hard. Tech in particular got hit hard, which is interesting in the light of the fact that the Nasdaq is down pretty sharply as well. So is this just a normalization, a recalibration of the tech sector that we are seeing here that was inevitable at some point, or is it something more sinister? Let's try and get an answer to that question. What do we make of the market action? Markets Live executive editor Mark Cudmore joins us now. Mark, what is this?
I think it is just recalibration, but that it can continue for some time, and there'll be knockover effects that will last for some time. I still think the US is likely to avoid a recession, and I think it's bizarre that we've gone, an imminent recession, I should say. It's not going to permanently avoid one. But we've gone from being pretty complacent about the US economy only 3 weeks ago to being convinced of a hard landing. Now, obviously, that hard landing is possible, and recessions do come on very quickly, and the market damage we're having at the moment has a real growth impact as well. So I'm not complacent about it out there, but I think the sudden turn in sentiment is quite extreme. I think there are three narratives to the market sell-off. I think one is the sudden US growth panic. That is perhaps a little bit overdone, but I wouldn't want to fight it just yet. One, there's a kind of deflation of the tech bubble. And that, as we've talked about a lot, Guy, there are extraordinary prices there for some of those stocks. And that can be a more ordinary calibration without it having broader economic impact. And then the third one is the policy misstep by the BOJ, which caused a clean out of some carry trades last week. Those three dynamics are causing pain across all assets, with a particular focus on Asian stocks. I've just not seen a day like we've seen in Japanese stocks ever.
I mean, I want to get more into the carry trade and the FX story we're seeing. But before we do that, I want to talk about this bond market, Mark, because you mentioned that there's this massive pace of deterioration that matters. What happens when it goes in the other direction? When you see a 10-year at 370 and suddenly it corrects or overreacts or whatever it responds to in the opposite direction, do we then see even more pain for stocks? What's the ripple effect of that momentum in the other direction?
Yeah, that's a good question. I don't think that's going to happen too quickly. I don't think that if we do see, these asset moves turn around at some point in the days ahead, I don't think the bond yields map happen first. I think bond yields only bounce after stocks bounce. It's after we get a little bit more comfortable with the growth picture. So I don't think it happens first. I think when we get the next move up in bond yields, it'll happen with a market that's saying, hey, the economy is still okay, if that's the case, and therefore stock prices can cope with it. I do think, though, there's still going to be kind of ripple effects from the VAR impact of funds getting stopped out, traders getting stopped out, and therefore seemingly unconnected positions having to be closed.
Where do I hide in this? What is a safe asset?
The dollar in the short term. In 2008, it was a US-focused financial crisis. The whole US financial system was in jeopardy of going down, and yet the dollar soared. And that was despite the fact that dollar yen was in free fall back then as well. Dollar works. At the height of financial panic, you do not turn to things like gold or even less so to crypto. They are bets on the monetary policy response that follows. They are the bets that if it gets really bad in financial markets, that central banks will print money again. They are essentially hedges against fiat currency being devalued. But in the moment of financial panic, all these assets get sold off, gold included, and crypto even more so because it's a higher beta version of gold. So therefore, in the very short term, dollar's the only good haven.